Today is the first Berkshire Hathaway annual meeting, today being Saturday, May 2nd. Since 1970 was someone other than Warren Buffett running the room. And Greg Abel walked into it with profits doubled, a record cash pile, and the stock trailing the S&P by more than 30 points. The last one was a negative, by the way. Since Buffett announced his retirement last May, that's when we started tracking the 30-point gap between the S&P and Berkshire. Abel told shareholders Berkshire would not do AI for the sake of AI, and is reportedly unwinding Todd Combs' positions after Combs left for JP Morgan. Michael, the prior most investors are carrying is Berkshire equals Buffett. Did anything Abel say today actually update that, or is the market right to keep selling at a discount?
Well, I think if you looked at it and you imagine that Abel, I think this is what his intention is to sound like Buffett. So if he had the equivalent of a system prompt, it would be Warren Buffett's character running that prompt. And then the output from Abel's mouth is essentially Warren Buffett, right? So there's that. And I don't want to imply that he doesn't have the same philosophy, that you go long, you look at the fundamentals. And this is actually something that I agreed with deeply, that if you look at the fundamentals of business, despite the efficient market hypothesis, do you know what that is? Where basically, because Wall Street is a random process, you can't find any competitive advantage investing because it's just random. Everybody has the same information and it's almost impossible to arbitrage, therefore to index funds. Buffett, though, rejected that. Maybe not completely. If you talk to him about it, he would probably acknowledge that it exists, but did believe that going into the fundamentals, you could take long positions and profit over the long term, not by doing micro trading, really fast turnover, paying all the fees, going with the hype trains. So that's consistent. The problem with that is, I think, what people are criticizing them for is, are you missing the AI boat? Now, let me do my contrarian thing. You don't invest in AI. You don't. And this is where I agree with Berkshire. You invest in companies. You look at their business model, you look at their strategy, you look at their capabilities, you look at their product lines, you look at their financials, their cash flow, revenue, bottom line, operations, etc. And then you determine, are they worth investing in given the environment that they're operating in? AI might be a part of that story, but it's not the whole story. In fact, I don't know. Maybe there are funds out there called AI that you could invest in, just purely AI.
Newbird AI.
Newbird AI, right? That's purely AI,
Yeah.
right? Maybe there are no fundamentals at all in that one. You can invest purely in AI there. But in general, I think this is my problem with AI again, is it's an enabling technology. And you have to specify what exactly you're talking about. Are the companies you're imagining using AI? Are they using LLMs? Are they using it for emails? Are they using it for new go-to-markets, digital channels? What are they doing? Computer vision, digital twins of their factories, operations. How are they using it? That you actually have to look at.
Yeah.
Just putting the word on AI on them, maybe they get a premium in the short run, but I think Buffett's point would be, in the long run, the business model wins. And since this show is called Show Your Priors, the prior of them, Berkshire Hathaway, is simply that business models that are strong today and have strong signals versus the market in the surrounding environment, they're going to profit over the long term and continue to produce cash. You can find failures of Buffett. It's not that hard. You can find them. But in general, that's been the principle. And if you look at their financials and their returns, it looks like it's worked over time. Now, counter argument to my argument, AI is different. This environment is different. We've all seen it. We've all seen when Anthropic comes out and makes an announcement. What is it? PayPal drops like off a cliff, or Salesforce will drop. The question is, will they stay there? Or are their fundamentals actually sound?
Right.
So that's the way I would look at it. I'm actually sympathetic to the view. I think you can hear that you look at the fundamentals. In I don't know if I'm not going to say it's a bubble, but I don't think we know what it is yet. So you're better off sticking to the priors.
Well, it's a interesting contrast. We talked about Jane Street just briefly earlier. They are a high volume trading outfit. They, AI trading, get those trades in as quickly as you can, that type of thing. Versus Warren Buffett, long term trading has been their philosophy for a very long time. So it's very interesting to see the dichotomy there, where for the past 14 consecutive quarters, Berkshire has been a net seller of stocks. So they've been recouping more cash than they've been investing for the last 14 quarters. That's since right after COVID, essentially. So they bought a big buy-in on the dip from COVID, and then ever since have been kind of pulling back because in Warren and the firm's eyes, the market doesn't make a whole lot of sense right now. If you look at Tesla and the Mag 7 and you look at its revenue and its declining revenue, versus what its stock price keeps going up and up and up, it doesn't make sense when you look at the fundamentals. So they've been hoarding cash versus piling it into Tesla. Whereas a lot of other people or a lot of other firms have been making a lot of money actually doing that thing and continuing to pile in, even though the fundamentals don't make sense. So I'm not exactly sure what's contributing to that completely. It could be a lot of retail investors that are now a little bit more savvy where they're buying the dip. I noticed that a lot when, past couple of years, right after Trump was brought in as president, and the tariffs came in, the markets just went way down. But they rebounded pretty quick, and the thought behind it was retail buyers are now investing a lot more than they used to be, and a lot more quickly. And with Robinhood, that type of thing, it's easier to do. The barrier to entry is so much lower. And the other thing it could be is the Fed is just so good at managing these things that maybe there isn't ever going to be a big downturn like there was in 1929, right? Who knows? But interesting thoughts, and very different fundamentals there for Berkshire. Classic M&A, classic long-term investing versus the Citadels and the Jane Streets out there, right?
Yeah, I think the last point I'd throw in there is it's maybe an irony of the position we're not only going to do AI. I think one of the great hopes of AI and for investors like Buffett is now is the time that you could actually do really deep dives into the fundamentals. I mean, we're building an application where we look into the deep dive, where we deep dive into the fundamentals of strategies of companies. You have the world's knowledge at your fingertips right now. Granted, there are proprietary databases that you have to pay to get into, but presumably Berkshire Hathaway has access to them. So with a good AI model, and I presume Berkshire Hathaway has some sort of proprietary investment methodology that you could load into the AI, couple it with research, give it more and more context, and actually it should make your method better because you're getting more data. So this would be ironic if they're not using AI in that sense. So it could actually make their method stronger. That would be interesting, right? And maybe this could be a counter to that. Maybe the days of I don't want to call them fundamentalists because it's not the right word, but people who invest based on the fundamentals like Berkshire Hathaway, maybe now retail investors with the proper tools could do similar work without the proprietary moat that maybe Hathaway has, or the connections, or the network, or the talent there, right? And the capital. So that could be another thing you're looking at. No longer could you say retail investors don't have the best tools in the world that they're in their hands. They're going to pretty soon. So it looks like it's all getting commoditized. So that's an interesting dynamic. When you look at firms like Berkshire, what's going to happen? And does going long work anymore when there's so much volatility in the markets?
Yeah. The last kind of point that I wanted to make was Todd Combs. He left for JP Morgan Chase. And he's going to be managing his own $15 billion fund over there. So all the positions that he was managing at Berkshire are now being liquidated by Greg Abel, the new CEO. So I guess what that says to me is that he didn't. So Todd Combs was the tech guy. He was the guy who made the big Apple play back in the day, and he was more on top of the fintech and the technology stocks, and that was kind of his area of expertise. And it's interesting that, especially now with a lot of bloated tech stocks, that Abel is liquidating those and exiting those positions now that he's got it under his control. So that was kind of an interesting thing. And maybe he's also doing it as to show that, hey, I'm the one in charge here. Maybe that's it too. And I also wanted to mention that, Warren Buffett's still chairman of the board, if I'm not mistaken. So he still does have a presence, and a pretty decent presence too, of being the chairman, right?
I think it's typical to see regime change. When you see a regime change, you get a strategy change. And it's just a signal that something is now different.
Yeah.
For some companies, they prefer continuity, but if this was a return to the fundamentals in this volatile market, maybe that's the message they wanted to send.
Yeah.
I don't know.
Yeah, that could be the strategy. Could be. Interesting. We'll have to monitor that and the progress on how that goes. Hey, you've just watched a clip from Show Your Priors podcast. Check out our main channel for full episodes. We have a new one every Tuesday. If you liked what you saw, give us a like and subscribe. It's free for you and helps us out a ton. Did we miss something during our discussions? Let us know in the comments below. Thanks, and we'll see you on the next one.